Welcome to the Startup Grind.
So this month, it's our pleasure to welcome Andy Dreyfuss for our fireside chat. Andy is a well-known angel investor in the Triad and in his role as fund executive for the Piedmont Angel Network, or PAN as it's known locally. PAN is a committed capital fund that's invested $16 million in 24 startup companies since 2002 via 3 funds with approximately 150 investors. Andy began his career at Apple in the early days of Macintosh and subsequently served as an analyst at SAP and then as an executive in strategy and planning for Coca-Cola in Atlanta. And then the light bulb went off and he realized he needed to move to Winston-Salem. So Andy moved here in 2002 from Atlanta. We're going to ask him why, to work in career development with Wake Forest. And he's now a partner with Venn Capital, co-managing 3 real estate funds focused on residential development in the hospitality industry. Venn Capital has participated in real estate transactions valued at over $50 million in the last 5 years. So please give a big Winston-Salem welcome to Andy Dreyfuss.
Let's shake your hand. All right.
Mic on?
What's that? Yep. Wow. This is quite formal.
That was the Triad welcome.
Was that Greensboro? What was
Yeah,
that?
that was Greensboro. All the way, we heard it all the way from
We love Greensboro.
Yep. So it's a real pleasure to have you here today. We had a conversation a couple of weeks ago in preparation for tonight, and you were telling me that you went to Santa Clara.
That's
is that
correct.
Right? Undergraduate, and then went straight to work for Apple.
That's right.
And this is in the 80s, mid-80s?
It was. They were a computer company, and it was 1986.
So real early.
Very early, Banley Drive.
Yep. So tell us a little bit about that. What was it like
Well,
to be?
let me preface. First of all, I'm not a technology guy, so I wasn't involved with anything to do with software, hardware, any of that stuff. I'm analytical. So my first role was in distribution. And to be frank with you, we were struggling to keep up with just supply chain to make sure we had enough computers where we needed them in the United States. And we were making the Mac in California, and we were making everything else was made by Sony in Japan. So the growth rates were just enormous.
So what did you learn in that environment, right? So,
Sure.
That was at that time essentially a startup that was scaling
Right.
just incredibly fast. So what was it like? What held it all together?
Well, a couple. First of all, I learned you had to work hard to keep up. Secondly, I learned that strong revenue growth can hide a lot of problems. And to be frank with you, Apple had problems at the time, but we were growing so fast with such big gross margins, we could just kind of buy our way out of it.
Yeah.
So people were getting promoted left and right very quickly. So I learned a lot from that.
And how did Apple attract talent? What were some of the ways that they got?
Well, it was a fun place to work, and there was, this was back in the 80s. There were blue jeans and alcohol and bagels and probably a lot of inappropriate behavior, to be frank with you.
So they marketed the inappropriate
They
behavior.
did.
That was their lead.
They did. It was a lot of fun.
So then you went to SAP, right? Which
I did.
Again, SAP is a German company, correct?
German, yeah, jawohl.
And they were when you were working with them, they were trying to get.
They had not. I don't know if you guys know your software. So they were a mainframe, and Richard Sterritz helped me. You know this stuff better than I do. But mainframe ERP vendor sitting on IBM equipment from Germany, and they had figured out finally how to do it in a client-server architecture, and they were rolling it out in the United States.
Right.
And they thought they had a winner.
So they are now the dominant, huge enterprise level system out there. So, and what were you doing with them? Were you helping them pioneer the U.S. market?
Yes, primarily in marketing and where to focus their energy.
Okay. And then you went on to Coke.
Yeah, I got a little tired of crazy growth and not. I have to be polite. I'm being taped here, but the Germans were very interested in keeping their software people happy. Everyone else was kind of, you were on your own.
Yeah.
And I didn't really want to move to Germany because that's what they wanted me to do. I didn't want to learn German. I didn't want to move to Germany, to be frank.
So what was it like to go to Coke, which is, the iconic
Yeah.
brand of brands, and
Well,
you were doing planning, strategic
Yeah.
planning. So
So
what
sure.
was going on there when
Well,
you
you're
got
moving
there?
from very rapid growth to not a lot of growth, to be frank, but a very, very well-run company. To eke those kinds of profits out of a product that's old, you really learn how to run a business in that type of setting with tremendous controls and planning, and it's a big bureaucracy, but regardless, you learn a lot about marketing and ops and
And you were
finance.
telling me when you were there, they were getting into the water business, the bottled water business with Dasani, right?
Right. We were late on that. We didn't want to do the water business. I don't know if anyone knows this, but the beverage companies make more money with cola than they do with water, a lot more. The gross margins are higher. The packaging costs are lower. The acid in Coke is good because it kills everything, so you don't have to worry about reverse osmosis and probably giving you too much. But we knew our margins would come down with water. But it's about share of stomach, right? This is a valuable lesson for startups. It's about share of stomach. And Coke knew what was going to happen was that America was getting obese and getting fat, and there would be a big move to water. And we were going to have to, we wanted that share, and we knew it would have less margin associated with it. And when you went to an internal meeting at Coke in Atlanta, any product you wanted, any product form was free, whatever you wanted, and as soon as we rolled out water, 12 people at the table, 8 would be drinking water immediately. So instead of Diet Coke and Coke.
So that was a big culture shift for them.
It was.
I mean, they saw what was coming and were trying to respond. Okay, so then you moved to Winston-Salem in 2002, and were in career development, right? You were helping with the career development arena.
Right.
So what brought you to Winston? I mean, that's quite a corporate career path that you've been through.
Couple things. Atlanta traffic motivated me to move. We had 2 small children. I don't know if I'm on tape here, but Atlanta's fairly soulless. If you live in the suburbs, you are a rear end in a cul-de-sac, basically, is what you are. There's no sense of place. So I thought, I don't want to live this way. I didn't have to. And corporate America, I was getting tired of reorgs and downsizing and fighting and trying to stay employed.
Okay, so it was a lot of it was family and quality of life.
Correct.
Okay, so it's not hard to get around here.
Yeah, in Atlanta, the first thing you do is you listen to WSB 750 AM. That's what you turn on at 6:15 in the morning for the traffic. And the fact that I didn't have to do that here just shocked me. It was
Gotcha.
just fantastic.
So what was your focus with the Wake students? I mean, what were you trying to accomplish with the
Well,
Wake students?
anytime you have students who drop out of the workforce, this is a full-time MBA program, you've got a very limited time to get them repositioned. They're dropping out of the workforce because they want to get into sales, or they want to get into investment banking, or they're not happy with what they're doing. So that's what the career placement office does. Tries to help them quickly figure out, hey, you were a Honda, you want to be an Acura. We can do that, but we have a very, very little time.
Gotcha.
That's what I've worked on.
Okay. And you told me that some of the interns were going to Pan, right?
That's how I learned about Pan. I had been an investor in multiple asset classes. I didn't know much about venture, and we had some interns. Pan needed interns. We had MBA students. You'd always go call on the people who were taking your interns, and I liked it. I didn't know a lot about it. I thought it was pretty cool.
Right. So then you learned about the asset class. You told me that that was really interesting. So what attracted you to the really early stage asset class, which is much higher risk? So what did you find interesting there?
Well, I think the whole premise of getting involved in something early and seeing it grow and hopefully adding value along the way, and if it all works out, there's a very healthy return.
So tell us a little bit about what is a committed capital fund, and how does that differ from other types of funds?
Sure. So most angel groups are a network around the country. That's where accredited investors get together, they pay some annual dues, let's call it $1,500 a year, and that gives them the right to come to a meeting and invest in your startup if they like it. Not the obligation, but the right. And so 50 people show up in a room. It's easy to get people in the room. It's hard to get them to necessarily invest. That's a network. Committed capital is the other way. We go out and solicit up front and say, hey, you want to spend $50,000. That's the minimum commitment. Do you want to spend $50,000 on probably 8 to 10 startups over the next 3 or 4 years? If the group votes yes, your capital will be put to work. That's the difference, but very few are committed capital.
Right. So instead of kind of having a right to access and making an individual decision. You're really joining the group, and it's the group
Yes.
that makes the decision.
Yeah, it's captain's choice golf, if you know the term, versus playing the course yourself.
Yeah, so this is really important, right? Because your score is usually better in captain's
It's
choice.
a lot better in captain's choice.
At least mine is.
Yeah,
I
Well, mine's
it's
pretty
dramatically better.
Mine's pretty poor in both settings, but yeah.
Yeah. So why is that?
Well, I'm supposed to motivate if we have entrepreneurs here. It's hard to pick winners. The startup land is not easy, and so the more brains you have involved in doing the due diligence and the assessing of the opportunities, the better your odds are for success. And then secondly, you can build a portfolio. It's critical to build a portfolio. And that's why mutual funds exist in the stock market, right? Portfolio theory says you will do better with 10 stocks than, statistically, than with one. So
Right.
you can do that in an angel fund. You can build a portfolio much easier.
Right. So there's really good math behind this in terms
Excellent.
of spreading your risk among enough companies with the
Yes.
opportunity to
Correct.
get a good return at the end. Because usually it's the outliers, the one or two outliers
Yeah.
are going to be what
Yeah.
gives you the return.
And I know I'm supposed to be positive here, and we're on tape, but in the angel space, and remember, these startups have been vetted. It's very hard to get an angel fund to give you money. So these are not fly-by-night ideas. These are well-vetted, strong, smart teams. 3 out of 10, the angel fund strikes out completely, gets 0. So this is like baseball. So you're going to miss the ball 3 out of 10 times. You will foul the ball off 2 times, meaning that you hit the ball, but it doesn't go forward, it goes backwards. You get some fraction of your capital back. So far, 5 out of 10, we're not doing real well, right? And there's a couple where you get maybe 1 or 2 times your investment. There must be one where you get 10 times your capital back. And that's how angel funds,
That's how it works.
and that's how venture works, by the way. 90% of the returns come from 10% of the investments. The issue is we don't know which one of the 10 is going to be the winner.
Right. Nobody knows.
No one.
If you look at
Right.
Y Combinator, they readily admit that
Right.
they're constantly surprised by the companies that
You
end
never
up being
know.
the unicorns.
This is hard, right? I mean, your business, your thesis, what you're doing changes while you're in the middle of it around you, right? It's competitive, right?
So you've looked at a lot of companies. You were in Pan 2, right? You
Yep.
started with the Pan 2 fund. How many companies do you figure you looked at during the course of placing that fund? Just guess. Over 100, right?
Well, a couple hundred at least.
A couple
Yeah.
hundred companies.
Yeah.
So what do you look for? I mean, what are the most important things that you look
Yeah.
for when you're beginning the
Sure.
process of analyzing a
Right.
company?
I think we are looking for a team. We want to see a team that has deep, and I mean deep, insights into a problem that they're solving that's connected to customers who will pay them to solve it. It sounds simple, but we want to see a problem statement that we understand, and we want to see them have deep insights into the customer so that we can validate, yeah, that's a problem for that customer, and they're going to pay you for that, so it all makes sense.
So the very first critical thing is this really a problem?
Is it a problem? And it might be a problem, by the way, but can you get paid to solve it? Because there are a lot of problems in the world that are problems, and they're not going to be, no one wants to, like healthcare. That's why we get a little nervous about healthcare. There are major issues in healthcare, but no one wants to step up and pay for it, right? Who's going to pay for it? Is it the government? Is it the insurance companies? Who does? And we stay away from that.
Gotcha. So how do companies get in front of Pan? I mean,
Well, I
what's
thi-
the first step, and what's the progression of steps that they go through to get
Yeah.
to the opportunity to pitch to the members and then go beyond that?
I would say there are multiple entry points. You can come in through entities like this. We like that. Sam is in the room somewhere. If you come through the Nussbaum Center,
Sam Nussbaum, thank
come
you
through
from Greensboro.
Flywheel, you come through someone's program, you come from a university's entrepreneurial center. That means you're taking the thing seriously. You could come from a lawyer. You come to some meetings. We always invite entrepreneurs to our meetings. It's like, look, if you want to see how this works, you can come watch American Idol. You don't have to be on stage. Come a couple times and watch so that you know. You only have one shot at it on stage. You want it to be a good performance.
Right.
The random emails are rare, very rare if you haven't done some networking. And you could come in through another angel group. There's a cabal. We all collude. I'll be frank with you. I mean, we all know each
Right.
other.
Right. Yeah, really aren't any surprises in the entire angel network.
There aren't, and there's no price. Well, I'm going to get more out of the guys in Raleigh and Charlotte. We all talk, and that doesn't really work because no one really has enough money between all the groups to really fund the entrepreneur the way you need to be funded. So it's a syndication generally.
Right.
So you can't play Raleigh off of Charlotte off of Greensboro for price. It's not going to work.
So, so what's the next step in the progression? So I get in front of you. You mentioned lawyers, by the way. I want to kind of highlight that because not a lot of startups realize that their attorneys can be one of their best sources of referrals into
Sure.
angel and venture capital, particularly if they're wired into the startup community. So, a little tidbit for people to remember. So what's kind of walk us through the progression. So I've gotten your attention, right?
So we don't need a full business plan. We need something that explains the problem. We actually tell you what we want to see. We want to see the problem statement. We want to see the product or solution, but don't kill us. 1 or 2 slides. We're not technical experts. We shouldn't know this business better than you, right? We want to know your customers. We want to see the business model wrapped around the problem, the customer, and the solution. So distribution, marketing, sales. We want to understand your financial plan. This is critical. How much money do you need now? How much money do you think you will need over time? It will change, but you got to have a point of view on that. Right. This is really, really important.
Right.
And then we want to know your thoughts on how long it will take and how much not money you'll make. You'll probably make no money. Where your sales will be in 3 to 5 years, and then who will buy your outfit? Because the only way we can get payback, someone has to buy our shares, right? So we want to know, one, that you don't want this to be a lifestyle business that you want to exit somehow. You want to sell out to a strategic partner.
Right. So as an investor, you're trying to create wealth, and you want to make sure the entrepreneur has the same idea, right? In terms of having an exit strategy and really understanding how that works.
When you take someone's money, you got to get it back to them. That's what we're looking for. We're looking for the entrepreneur's hunger to say, look, I really didn't want to take your money. If I had it all myself, I wouldn't have, because I would advise you, if you have the money, do it yourself, because it's once you start using other people's money, there's conflict and tension, right? Right. We want to get paid back and make a little bit along the way, not a lot. Nothing like small footprint, just a little bit. Teeny footprint versus small footprint.
You try to get that information, and then
so we get that, and then we go through a screening committee and says, hey, this looks pretty good. This is all reasonable. The pre-money valuation makes sense. We like the problem statement. They don't need enormous gobs of money. The team looks like it's credible. Let's bring them in for a screening. And so we do that. It's very casual. We walk through that deck. It's 3 or 4 people around a conference room. It's 30 minutes. Very casual. Real-time coaching. Hey, everything smells good, looks good. We want to invite you to a member meeting, and that's generally 2 weeks later. And then you get up on stage, and you'll have 30 minutes with a PowerPoint, and we want you to do the same thing with maybe some modifications.
So do you advise them on any modifications?
Absolutely.
Their pitch deck and the screening?
Absolutely, yeah.
Okay, so you kind of coach them on how to prepare.
Absolutely.
And then the pitch is really kind of critical to advancing to due diligence, right?
It is.
So,
I mean, you can have a bad pitch and get to due diligence. It's happened. If your problem statement is solid and your solution and product is differentiated, we're like, wow, okay, that wasn't, maybe they're just a little nervous. That's okay. Deep insights into the customer. That's all good.
Right. So, and then the members vote.
The members vote to go to due diligence. That happened about half the time. We would vote to go to due diligence, and then a due diligence team forms, and we have this long, daunting list. But to be frank with you, we focus right in on customers. Tell us who your prospects are. We want their names, we want their phone numbers, and we want to talk to them about their problem to see if it matches up with the problem you've told us they have. And are they going to pay you to solve that problem? And if we don't hear that, hey, that's not a problem, I don't know what that's, no, or it doesn't match, or you know what, yeah, we haven't figured out the pricing. It'd be nice if it gets solved, but we're not sure. That's our red flag. And we look for reasons to stop. But that's where we start, right there.
So that's really important for everybody to hear, I think, is, if you come make your pitch and basically you have no customer evidence, right?
We're not interested.
It's not going to make it to the
Because we really
through diligence.
we want our capital to be used for sales and marketing to maybe finish out your early beta work? Maybe, but hopefully you've gotten all bootstrapped to the point where you have a minimally viable product. You know customers will pay you if you can get this thing, shrink wrapped and a little sexier looking and distributed, right? I'm using analogies. We don't want our money to, hey, I got an idea, and if I just could get a beta together and show it to 7 people, I know that they would say yes. That's too much risk, or your valuation doesn't match up with.
Right. So in the diligence meetings, do you use a scorecard of some kind? I mean, there's got to be a lot of dissent, right? Or
We do.
I'm sure not everybody agrees on every startup, right?
Yeah.
So there's some lively conversations about we really should, we really shouldn't. So how do you do the scoring?
There's 12, I don't have them all memorized, there's 12 factors that we look at. So CEO, management team, their marketing plan, their financing plan, the size of their market, their uniqueness, their exit potential, IP, intellectual property, if there is any. They all have a different weighting, right? And it adds up to 100%. And then we score them from basically a -2 to a +2, with 0 being neutral. And
Gotcha.
anything that gets above a certain score means generally that it should work.
Right. And then you go back to the general membership and
we
make a recommendation.
We have to pitch. The due diligence team pitches and says, hey, Ryan Pratt, Gorilla RF, here are the positives, here are the risks, here's what we like, here's the bet, by the way. It always boils down to, there's generally a milestone that has to be achieved early, and that's fine.
Right.
You want these things to either succeed or fail quickly. What's that bet? What has to happen first for this thing to work?
Gotcha.
And if we can identify that and get the members to say yes, we move forward.
Okay, so I think this may be my last. Well, I got 3 more questions.
Audience looks a little
Only
dazed.
3 before you guys glaze over. So if there's no real history on the company,
Sure.
These are all very, very early stage. How do you do the valuation? How do you come up with a pre-money valuation?
Well, first of all, valuation is associated with risk, right? So the less you have done and proved, the less you will get paid up front because you haven't, there's nothing there, right? So the more you have done, you will get a higher valuation. There's a range of valuations generally. Like it's a marketplace. There's a range, right? So the low end would probably be $1 million pre-money, right? And the high end might be 3 or 3.5 here in the Southeast. If it's a startup that really doesn't have a lot of revenue, right? So we assess in there where are you on that risk continuum. The other way we do it is we go to the end. We start it with the end and say, all right, if you can grow this business, it's a $300 million industry. You say you're going to get 15% market share. We don't believe that. We're going to cut it to 5, right? 5%, which is great. You'd be a $15 million business in 5 years. We'll take the time and stretch it out. And the multiple in that business, it's 3 times sales, let's say. So we've got a $45 million business. It's going to sell for $45 million in 5 years if it all works, right? If it all works. Well, we want a 10x. Therefore, the pre-money and the amount of money you raise can't be more than 4.5. Because 4.5 times 10 is 45. I don't know if you guys followed that math. So we'll back into it the other way. We'll just say, hey, what can we afford and what do we think is realistic? And it's kind of a little voodoo. And a lot of it's if we like you and,
Right. But it is important for the company that's coming to you to at least understand how that math works and what's a reasonable ask and what's a unreasonable ask, because that'll kill it at the end.
Yeah, I mean, we help the entrepreneur along the way because most entrepreneurs don't know this stuff early. Maybe if they've been schooled by Sam or somebody, but if they're coming in cold, we'll work with them to explain, hey, $10 million pre-money doesn't work doesn't allow you to raise money later, and it doesn't work for us.
Okay. 2 more quick questions, then we'll open it up to the audience. So what's your top advice for investors?
For investors,
Yeah.
expect some failure. Remember, we're playing baseball. No one hits 1,000, right? And that's
Right.
okay, right? That would be and build a portfolio.
Right. Spread the risk.
Yeah.
What's your top advice for the startups?
To be malleable. We're watching to see how. Obviously, you've got to have the customer and the problem statement. That's just obvious. You have to have that. So assuming you have that, then we're watching for how malleable you are about your business model around all that. because it's going to change. And we want to see if you can learn and grow during the process.
So being malleable is the same thing as how well do you listen?
How well do you listen? How coachable are you? Now, you also have to have a point of view. You can't let people like us run you over as well.
Right.
Because we don't know anything.
Right.
Right?
Gotcha.
We know a little, but.
Okay, let me open it up to the audience here. Who's got some questions for Andy? Okay.
Yeah, so after your due diligence, let's say you score them well, they come in, let's say, a 1-7 on the scale of -2 to +2. So they look like a pretty solid bet, I'm assuming.
Yeah.
What does the funding time typically look like in kind of,
Okay.
and I say that in the scheme of thing, like, you know, so a company's getting ready to get some funding, they go through a month or 6 weeks of getting to the pitch and getting everything put together. What's the closing look like?
Well, first of all, I think the due diligence process can take us 90 days. I mean, by the time we do our due diligence and get our members to say yes and all that could be 3 months. But then if it's a committed capital fund, you should be funded in 30 days. But if we have to syndicate, and we generally do, that means I got to go out and convince someone in Raleigh and Charlotte to join me, right? And we will wanted you to start doing that as well. We'll help you. If the due diligence is going well, we'll tell you, hey, you need to go down to Charlotte and talk to these guys. We'll get you on their calendar because it's going to take a syndicate to raise your $1 million. We can't do it ourselves.
And then a follow-up would be how much are you typically looking to invest?
Yeah, so we're typically looking to invest, it depends on the size of the fund. I mean, Pan 2 was investing about $500,000, but they would do it in 2 tranches, $250 up front, and if you needed another $250. Pan 3 was smaller, so it's been a couple $100,000 per investment.
Is there a particular business vertical that Piedmont and Venn Capital focus in, whether it's tech, pharma, biotech, manufacturing?
Right.
Do you guys have you kind of fallen into a particular business vertical that, you know, just over time it's like, well, now we're kind of known for working with X type of companies?
Right. Well, a couple things. I know we're in healthcare land here, but you know, healthcare is difficult, right? Because the amount of time and money. So that scares any angel group. We're actually looking for opportunities that can scale without a lot of capital, right? Because raising money is hard. So we're looking for capital efficient startups. We're looking believe it or not, we are looking for opportunities that aren't too big, right? Because if they're real big, that means the super VCs and the smart money in California has probably already been there, or they can outspend us. So we're actually looking for kind of niches, software or technology generally.
What's the involvement of their or post-capital infusion with the ongoing business of the companies you guys are
Yeah, it's generally in 2 areas. It's around raising more capital if you need it, and it's around your sales and marketing efforts, generally. That's what's good.
How do you hold these startups accountable with regards to transparency, metrics, and things like that?
Well, generally we have a board seat, so we see all that, and that's usually not an issue early. It can be an issue later as a company grows and adds a ton of capital, and then you have the venture capitalists involved, and then they can try to dilute you and be bad and evil and
We're not that bad.
yeah, I know.
Okay, more questions? Pamela, how are you?
Good. I can talk now. I had laryngitis for a while. I was wondering if you could tell us a little bit about what the range of equity split is for the companies that you invest in.
When you say equity split, help me.
The amount of equity that
We're getting.
PAN is looking to
Yeah, I mean,
receive.
we want to have some influence and some size. So, I mean, I think 5% would be the minimum, and it can go up to 20%. That's going to depend on the pre-money valuation and also how much capital comes in. But I'll give you a good example. We've invested in a company in Charlotte. We're going to get a $1.7 million check later this quarter. At one point, we had 8 or 9% of that company. Now we're down to just a teeny little fraction. So you almost have to prepare to be chopped down. But that company's raised tremendous amount. So we want to start with a decent base to start with. We don't want a majority. Angels never want a majority position. The entrepreneur needs to be in the majority.
Right.
By far.
Have you seen any trends here in North Carolina or the Southeast in terms of the types of markets that seem to excel in the startup environment?
Yeah, I mean, I think we have a, you know, in Atlanta, for example, it's internet and it's security, and in Raleigh, it's software. I think it all depends on the team. We generally can compete. I think where we would struggle is if the startup needs, you know, $50, $100 million, that's really not easy to accomplish here in North Carolina. Big footprint, I'm getting nervous.
Hey, Andy. So my question, one of the first things you said was, what you're looking for, you said looking for a team.
Right.
So can you talk a little bit more about what makes a great team? Like,
Sure.
how many people, what sort of
Sure.
skill sets, what are they doing today?
Sure.
How does that all come together
Yeah.
for a startup that's
Yeah.
looking to get
Well,
some
one, we
funding?
like, Richard, it's a good question. We like a team because I think this is too hard to do by yourself. It really is. So many decisions, and so we're looking for generally the team, a technical person who really understands the problem, who's technical and deep with the solution, and generally with customers, right? And then we're looking, that's one, we have to see that. And the second is then we need to see someone who can sell and market post-commercialization. And I don't want to offend anybody, but those skills don't generally lie in one human being, right? If you're super technical and deep with software, you tend not to be the best business development channel partner cat, right? So can happen. So that's what we're looking for generally. Then in terms of the team, yeah, then we're looking for a little bit of finance, but not too much up front, just a fractional piece of somebody. And we're looking for some depth technically, and we're looking for depth in sales and marketing. That's what we're looking for.
So that's why Woz asked Steve Jobs, what do you do?
Probably.
Right. So that's why it's good to have that kind of complementary
Yeah.
skill set on the team. So, more questions?
How you doing?
Good.
Excellent. Education, is that something that you think is a
Yeah.
booming business?
Yeah, and here's why. You know, the spend in higher ed and K-12 is enormous, right? And we know that's an inefficient system, right? And we know the American public is unhappy with spending huge dollars on higher ed in particular, and it's going to change. Technology will ratchet out cost in that industry. Now, who's going to win, we don't know, but yeah, we've seen a lot of good startups in higher ed in particular. K-12's more problematic, big spend, but you got to go through every school board or the State Department of Education, which is a nightmare, right? But yeah, education's ripe with problems, right? Good people, right? I don't want to offend any school teachers, but there's issues there, right?
Any more questions? Yep.
All right, so I was doing the math earlier. You said like 13 or 16 companies that Pan's invested in, or whatever that number was.
Well, it's really about 24. I'm not sure what
24. So where I'm trying to get to
Yes.
is you have your processes.
Sure.
Your each milestone. What's the
Cut.
rejection rate at the beginning there? How
Sure,
many?
so-
What's the total number?
Yeah,
And
so I would say a typical year, an angel fund would probably see or hear about 200 startups, right? 200 startups, and you probably you want to screen 3 a month. That's about so the first cut is, and a lot of them are easy to knock out, right? But I'd say 36 get a real serious look, and of that 36, probably 24 make a member meeting. So you have pretty high odds. If you can get to a screening meeting, you have high odds of making a member meeting. And then of that 12 that get to a member meeting, 24 that get to a member meeting, I'd say about 24 get a member meeting, 12 get the due diligence. We might pull the trigger on 2 in a given year. And that's just like venture capital, by the way, because it's the same asset class. It's very difficult to raise capital. It should be, by the way. This isn't a Forsyth County sewer bond, right? I mean, right? People are going to flush their toilet tonight. A lot of people in Winston-Salem, and it's all going to wind up in the Yadkin River. We know that, right? There's not a lot of mystery there, right? Sorry, was that too graphic? We're being taped. Forsyth County is a good credit, by the way. If you're into munis, we live in a great county, by the way. We're really well run. Our water system, our sewer system, our roads. This is a top-notch place. A little better than Guilford, by the way, Jennifer.
Sam, back me up.
Hey, financially, you guys got you're bigger. Yeah, you're bigger, and you guys think you're sexier, but you're really not. You're really not. We're svelte and lean. Yeah, I'm
Stop it, I'm blushing.
So I'm curious, besides Andy Dreyfuss being there, what's unique about Pan?
Well, I think like any angel fund, I don't know if there's anything unique. I think with Pan, I say this with pride, we've actually lost probably more money than any angel group in North Carolina because we've been at this since 2002. So what you get is an institutional knowledge of how to do this. So from the investor side, we've lost money so many different ways we now know what not to do. It's hard, right? So there's some wisdom. By the way, in Pan 3, every company we've invested in, now we've been a little risk averse, every company, that's 6, has made it to revenue. You know how hard that is in startup land to get to revenue? Very difficult to convince someone to write you a check. So I think from the investor side, from the entrepreneur side is we can guide you through the process. We're not bad people, and we can help you syndicate because you're going to need syndication. So Ryan, Grill RF, I mean, he was a very competent guy, but he needed us to help him syndicate, and we gave him credibility.
All right, good lessons. Please, one more? Have we got another question? Or that's a wrap. Andy, thank you
Okay.
very much.
All right.